Before we begin, just a quick note. This podcast is produced by qualified financial professionals and is intended to share general information and insights to help expats better understand common financial topics. However, everyone's circumstances are different and regulations can vary by country, so nothing discussed should be taken as personal financial, tax, or investment advice. If you're considering making financial decisions based on anything covered in this episode, we recommend seeking professional advice tailored to your individual situation.
You're listening to Expert Money Matters with me, Georgina. At Chase Buchanan, our goal is to provide total clarity in an uncertain global landscape. To help you stay connected and updated wherever you are, we've adapted our weekly market update email into this convenient audio format. Here is your weekly update for the 3rd of June 2026.
Good morning or good afternoon, depending on where you are in the world. In last week's update, we looked at the fragile balancing act facing investors and expatriates. Strong market momentum on one side, narrow market leadership, geopolitical pressure, and tightening tax borders on the other. Over the last 7 days, those tensions have moved from abstract risk into real-world impact. We have seen concrete market movements, sharp currency pressure, and new legislative details that now require immediate cross-border planning. So here is how the landscape has changed this week and what it may mean for your capital. First, the next phase of the AI rally, the scramble for data center balance. Last week, we warned that many so-called global portfolios are dangerously exposed to a tiny handful of US technology companies. This week, we are seeing an important shift in why those valuations are rising even further. The S&P 500 has now reached a record high of 7,580. The driver is no longer just broad excitement around artificial intelligence. It is the physical hardware race needed to support the rise of Agentic AI. These are AI systems that can act autonomously to complete complex workflows rather than simply responding to prompts. To understand why this matters for data center investment, it helps to think about computer processors using a kitchen analogy. The GPU is like an army of thousands of junior line cooks. They cannot manage the kitchen. They cannot think through complex logic. But if you need 10,000 carrots chopped at the same time, they are unbeatable. When technology companies were training AI models, effectively teaching them the recipe book, they bought huge amounts of GPUs. The CPU, on the other hand, is the head chef. It reads the complex tickets. It manages the workflow. It decides what needs to happen and in what order. As AI moves from training to autonomous execution, the demands change. For example, imagine asking an AI system to independently audit a company's financials. That requires constant logic, sequencing, judgment, and decision-making. If a data center has thousands of line cooks but not enough head chefs, the whole system bottlenecks. That is why technology companies are now rushing to buy both types of processors to rebalance their infrastructure. This has triggered a huge wave of capital expenditure projected to reach $754 billion this year, and it is lifting technology valuations across the board. This week, the market will be watching critical infrastructure earnings from Broadcom and CrowdStrike. At the same time, Goldman Sachs is managing a massive $75 billion market raise for SpaceX. The key point is this. This narrow concentration in technology and AI infrastructure remains the main driver of global portfolio returns right now. Second, geopolitics and energy. The optimism has fractured. Last week we noted that oil prices had calmed, partly because of cautious diplomatic progress around the Strait of Hormuz. This week that fragile optimism has broken down. Following an escalation of military operations in southern Lebanon and renewed skirmishes in the Gulf, Brent Crude violently reversed its recent decline. It has now spiked past $94 a barrel. Betting markets have reacted sharply too. The probability of normal maritime traffic returning by the end of June has dropped to just 27%. There are still some buffers in the system. Strategic reserves, especially in China, and flexible European refining margins have helped prevent an immediate supply cliff edge, but that cushion is being depleted. For expatriates living in Europe, this energy spike acts like an imported tax. It can push up local inflation. It can affect household heating, electricity bills and flight costs, and it complicates the decisions of the central banks that influence your savings, pensions, investments and currency exposure. Third, macro splits and the Eurozone squeeze. The interest rate outlook we discussed last week has now turned into a clear split between central banks. And that split is putting direct pressure on currency pairs. The European Central Bank is currently at 2.25%, but it has now broken ranks and is openly preparing the ground for a possible rate hike to 2.5% at its June 11th meeting. The reason is sticky Eurozone inflation, currently at 3.0%. The Bank of England is gridlocked at 3.75%. The UK economy is cooling, but energy-driven inflation fears mean that a summer rate cut has effectively been priced out, so the UK is stuck in a higher-for-longer stalemate. Meanwhile, the US Federal Reserve is holding steady at between 3.50% and 3.75%. It is waiting for the critical non-farm payrolls data on June 5th before signalling its next move. The currency impact matters. As the yield gap between the UK and the Eurozone narrows, the pound faces structural downward pressure against a strengthening euro. For British expatriates who draw income in pounds, such as UK pensions or rental income but spend in euros, this creates an immediate reduction in real-world purchasing power. Fourth, local rules, fresh legislative realities, and stricter hurdles. Last week we warned that European tax planning is becoming more fragmented. This week, new announcements and recently active regulations have brought the fine print into sharp focus. Let's start with UK pensions and inheritance tax. For British expatriates topping up their UK state pension from abroad, a major change has just taken effect. HMRC has officially abolished the cheaper voluntary Class 2 national insurance rate, which was £182 per year. Expats are now forced to use Class 3 contributions at £923 per year. That is a 5-fold increase. And there is another important change. New applicants must now prove either 10 years of continuous UK residency or 10 years of prior contributions to qualify. That replaces the old 3-year rule. This sits alongside the new residence-based inheritance tax net. Under those rules, strict tail provisions can potentially keep your global estate within the 40% UK inheritance tax net for up to 10 years after you physically leave the UK. Now to Italy. For affluent expatriates considering Italy's popular flat tax regime, known as Article 24 bis, the financial goalposts have moved significantly. The annual substitute flat tax on foreign-sourced income has increased from €200,000 to €300,000 for the main taxpayer, and the accompanying fee for each family member has doubled from €25,000 to €50,000. That dramatically changes the cost of relocation for high-net-worth families. In Spain, the picture is regional. The federal solidarity tax continues to penalise net wealth above €3 million across Madrid and Andalusia. But there is more positive news for property holders in the east of Spain. The region of Comunidad Valenciana is introducing a new 25% inheritance tax allowance this month. In June 2026, that allowance is scheduled to increase to 50% next year. For some families, this could create an important window for succession planning. In France, the authorities are actively enforcing the new 20% wealth tax on holding companies that own non-operational luxury assets above €5 million. France is also applying a 10.6% social charge on investment income. And in Portugal, the post-NHR framework continues to squeeze retirees. The replacement IFICI regime is strictly limited to active scientific and technological professionals. That means passive investors may be exposed to standard progressive tax brackets of up to 48%. So what does all this mean for globally mobile families? The theme of this week is very clear. Passive management is becoming a high-risk strategy. A supposedly diversified global equity fund may, in practice, be a concentrated bet on data center processors. A quiet change to UK pension eligibility from abroad can dramatically increase the cost of topping up your state pension. A sudden flat tax increase in Italy can change the financial logic of relocation, and a regional tax change in Spain can open a planning window that may not stay open forever. The financial environment now demands active structural review. Your currency exposure, asset concentration, and local tax residency need to be aligned. That is no longer optional. It is becoming a prerequisite for protecting your wealth.
And that wraps up this week's Market Snapshot. If you'd prefer to get the information before it's published here, you can sign up for the update directly on our website. Just visit chasebuchanan.com and subscribe and get the update delivered straight to your inbox, giving you a head start on the week. Thanks for listening to Expert Money Matters. I'm Georgina. Join us next time as we explore money matters for your life abroad.